hard to believe, but the next Fed meeting is almost upon us. It's just 2 weeks away on September 18th, and a quarter-point reduction is expected. But economists at Renaissance Macro have outlined the simple three-part case for why the Fed should be more aggressive this month and cut interest rates by 50%. Renaissance head of economics, Neil Dutta, refers back to what Powell cited at Jackson Hole: global growth, trade policy uncertainty, muted inflation. Look, we had the 50 debate.
That's right.
Before the last meeting as well, and it is rearing its head again now. This time, do you think it's even more possible that we would see a 50 cut here?
I mean, I think, look, the reason the Fed is so reticent, in my view, this is my interpretation of how they're behaving under Jay Powell, to cut by 50 basis points is because they are concerned the market will believe that is a signal about they know something about the economy. And so if they act too forcefully, they are, by extension, saying the economy is in worse shape than we thought it was. Now, I think kind of what Neil is going for in this case is something that more people have discussed, which is like, well, you have the tools. You have the ability to cut by 50. Why are you going to save that? You know, like Rosengren last night, Eric Rosengren, Boston Fed president, last night was saying, we're not in a recession, so why would we cut interest rates? Because we should wait for the recession. But kind of the hipster take on that has now become, that's stupid. Why are we going to wait for a recession to show what we've got? We have the cards, let's play them. Because the point that Jay Powell has laid out for even taking this course of action has been, let's elongate the expansion. Let's not act like Alan Greenspan. Let's get out ahead of what the economy might be doing, because we actually can pull some levers on the economy.
So that's exactly, we had Neil Dutta on the ticker earlier. That's exactly the argument that he made, because I saw this and thought, well, 50 basis points is an aggressive cut. And if you really do think that growth is decelerating, you believe the data is pointing to that, why use the arrows right now? Why not have additional levers in your pocket? And that's exactly what he said. He said, look, why not use it then? If you can continue to extend the cycle, you should do that. You should move forward on that. I think the other question that I've been asking a lot is, is it really enough for the central bank to move forward? Is there really a fiscal component that needs to come with that? I think that's a big discussion that's been happening on the European side of things, especially because of the slowdown in Germany. But I do wonder in the US, at what point do we say the Fed alone can't do it? I think you can already argue that. So then what happens?
I think that's the big risk with the president continuing to harp on the Fed. Like, these are magic wands and not rate cuts. Like, I don't know that what moving 50 basis points is going to be able to deal with what's happening coming on the trade front.
And you're right, the expectation is so big now because the president has continuously tweeted saying all it takes is for the Fed to cut. And if they cut and you don't see a big turnaround, then what happens?
Then what? Like, where are all the structural reforms? Where is any change coming from Congress? Like, 50 basis points doesn't seem even adequate to deal with what's coming down the pike.
Okay, but we've had interest rates fall tremendously. That is a huge tailwind to home buyers. It's a huge tailwind by extension then to consumers. I mean, in a way, the 50 basis point cut has started to already pass through to the economy, right? And so I think that, yes, obviously the question will become, and has been since the crisis, where does fiscal policy come into this? Now, the other side of that, this is kind of a newsroom debate I have with Brian Chung all the time, is didn't the Fed implicitly push back against a massive fiscal stimulus package that was passed in 2017, right? Tax cuts was $1 trillion stimulus. The Fed raised rates 4 times last year. And if not to counteract what they saw as an unnecessary overheating or heating up, I guess you could say, of the economy, then what else were they really doing? So again, I think it kind of comes to, if Trump's going to start this trade war, then and this is the Bill Dudley take, right? Bill Dudley doesn't like that the Fed might be helping Trump's trade war. But if the Fed can't set fiscal policy but can only react to it, well, then the natural thing to do would be for them to cut interest rates in the face of a trade war. That's the other side of this as well. But I think, to Neil's point, it's like we don't even have to play that game. We don't have to do the Dudley cosplaying, who's in charge, is there a deep state, all that BS, right? Like, we can just say we have slow growth, we have a manufacturing recession, we have low inflation, there's a strong case for you to act forcefully.
Sure, totally, and they can do it, and maybe they will, but is it going to change anything? If you look at the beige book, it's about uncertainty, and how do rate cuts combat uncertainty on the trade war.
Well, they don't.
And also,
So
they
then
don't.
that's not
They
gonna
don't. But they
solve the
lower.
problem.
But they lower interest rates. That's all the Fed can do, and interest rates are significantly lower now. Like market rates are lower.
Also, the Fed doesn't operate in a vacuum, right? We've heard so many analysts say
Yeah.
that, but it is true. And when you look at what's happening over in Europe, I can't help but think, even if the Fed acts, there are a lot of things out of the Fed's control.
Yeah.
Outside of the US.
What does Madame Lagarde do? Right. We're about to find out in 2 months. So, anyway, I'm now Team 50, I guess.
Team 50,
Why
wow.
not? You know, it's more exciting to be Team 50.